And good afternoon, everyone. Glad to have everybody here for our quarterly market update webinar. My name is Paul Muller, and I am joined by Mr. Nick Tabor, Mr. Benjamin Stark, and we're very fortunate to have a guest appearance from Mr. Kevin Leeds. So, welcome, everybody.
Okay. Good afternoon. Good afternoon.
Yes.
Happy summer.
Yeah, happy summer. It's been a crazy 3 months, huh?
Definitely.
Yeah, I always use this time when we have these webinars to sort of think about and reflect on, where we were the last time, that we had this webinar and, a little bit different times, right? We just had started the springtime, got into earnings season and a war and, tax time, right? We were really trying to hunker down on getting some taxes done and Kevin is going to be gracious enough to talk to us about some taxes today. So with that introduction, why don't we go ahead and get started? Just some housekeeping too. We usually take about a half hour, 45 minutes to go through the information here. And also, if you have any questions, we'd love to get them. Please feel free to use the Q&A on the Zoom bar, and we will go ahead and get those questions answered for you. So as we always do, we like to start with really where we've come from, but not just over the last 3 months, but beyond. So we'll start with our heat map, new and improved.
Slide.
There we go.
There we go.
So this is the typical heat map that we look at when we're looking at the markets. This gives the ability for us to really break down markets into, a lot of different areas, both equities and bonds, and then breaks it down further from there. So, Ben, I know this is also one of your favorite tools that we use
Yep.
in trying to explain to clients, exactly what's going on when we peel back, the shell on the S&P 500. So maybe you can give us a little bit more detail about what we're looking at here.
Yeah, I'd love to. So I think what's really changed for us as advisors and investors and clients is really the shift in where one of the asset classes that has been in favor for years now actually fell out of favor for the first time in a very long time. And some of the asset classes that have been out of favor for years are now actually in favor. So I really want to focus in more so on the middle one here, which is the U.S. size and style, right? So, we can see that and this is going to be from year to date down in terms of performance, right? So we can see that small cap stocks, small cap value stocks, small blend, and small growth stocks have actually performed the best over the last 12-month period. And small cap stocks have been out of favor for years, a long time. And the asset class that dominated was US large cap growth stocks, which now, for the first time in, I can't even remember how long we've been doing these webinars for, guys, is large cap growth stocks are at the very bottom.
Yeah.
So it is truly, I guess, amazing to see the shift in where certain asset classes have fallen out of favor. And we'll talk more about, why that sort of happened. And I think also just as equally surprising are emerging markets in the upper right-hand corner here. You can see that emerging markets have just absolutely crushed it over the last year to date. I mean, up almost 24%. And alongside small cap stocks, right? I mean, emerging markets were so out of favor for so long. I mean, years.
Tremendously out of favor. I mean, you look at the headwinds that emerging markets face, and emerging markets is one of those asset classes where you got to be careful with, right? Because the volatility, I mean, they go up and down 50%, like nothing, and you can see that here. So, some of those headwinds have subsided, and we're starting to see some really impressive kind of numbers there.
Yeah, I mean, we've even seen the shift coming from money managers directly, Paul, right? Where money managers such as BlackRock, JP Morgan, Fidelity, I mean, for so long, when anyone looked at their models about what they were doing, I mean, they were like 96 to 98% domestic stock. That's where they concentrated all of their asset allocation. And we've seen that shift now where some of the models might be 85 to 80% domestic stock. And we've seen a big bump of 15 to 20% in either international or emerging markets. So there's definitely been a big change in the trend.
Yeah.
over the last really as of this year mainly, but last 12 months, but really in the last few 6 months here.
Yeah. And this is, this to me is the bread and butter of tactical asset management, right? Because, when you look at, hey, I'm just going to put all my money in the S&P 500, that's fine and good. And, I'm not one to say that I don't enjoy the S&P 500, but, when you look at that extra return that we can add without really increasing risk by adding, 5, 6% of an asset class to a client's portfolio, we're really able to drive that. And likewise, reduce, on a client's portfolio. And, one of the things that I was having a conversation with somebody earlier in this year was the emerging market debt. And, we had figured, as the international markets had opened up and interest rates started coming down, that emerging market debt would be another one of those areas where we could add a little bit of a twist, and an allocation to add some beta. And we've seen that come in as it relates to the fixed income market this year. So that's been really interesting to see. And the other thing that, and I guess this may scare me a little bit, but we're not seeing a lot of red. And that, obviously we don't like to lose money, but it's been a pretty impressive market, all in all when we look at it. Again, the one factor here that we've been lagging is that large cap growth.
Yeah, absolutely. And despite the blip that we had, earlier this year in the spring and March when Bermuda's got shut down, I mean, there was a lot of fear about having prolonged effects to the markets, and we really didn't see that even across most. I mean, you see some red on like the 1 day, 1 week, 1 month. That's not such a big deal, but you still see the year to date numbers pretty much across the board are green. So it's just shown resiliency of global economies, United States economies to persist through. And obviously that conflict was relatively short-lived, which really helped a lot of the numbers here.
Mm-hmm.
All right. So again, just sort of piggybacking off that chart, this is a little bit more consolidated just to give a broader spectrum of asset classes as a whole, right? So year to date, again, we can see that US small caps have just completely dominated along with emerging markets. I mean, if you owned any small cap stocks or emerging market stocks, you'll have seen that your portfolio probably did really well relative to your peers or maybe other people that you talk to at work, especially in the 401k space, right? If you owned any of those funds in your retirement plans at work. So again, this just reiterates the fact that small caps, emerging markets have really come into favor relative to the S&P, which still a very strong return at 10% year to date. I don't think anyone is going to be mad about getting a 10% rate of return, but still pretty impressive to see. And actually surprising me, which wasn't on the last chart, if you look at the Mag 7, right, which is Google, Amazon, Microsoft, Tesla, so on and so forth, that those stocks are actually down year to date, and we haven't seen. I mean, maybe in short bursts we'll see them drop, but seeing them down year to date is really something. I mean, we haven't seen that in such a long time. So to me, I mean, that's also a big reason why the S&P, because the Mag 7 takes up like 20%, 25% of the S&P 500 index, and they've really been a lagger this year compared to the leader, where we've seen the Mag 7 just completely boost the US large cap stock market.
Yep. And, it's interesting to point out because, when you get in front of momentum, whether it's AI, it was the Mag 7, emerging markets, small cap, whatever that momentum trade is that you put yourself in front of, it's important to realize that trade doesn't last forever, right? So, we put this up here specifically because, when we look back, 2 years ago, it was all Mag 7, right? I mean, nobody would want to own anything other than those stocks, right? And now we're starting to see, those values, sort of trying to catch up to the stock prices. And, at some point, the AI trade is going to be in that same type of a mode. So, we're going to talk a lot about AI today. But, Nick, I also wanted to point out gold and Bitcoin, right?
Yeah.
Those are two areas where, we saw everybody jumping on the train.
Yeah.
And, I use gold as the, I call it the grandma trade, right? Where grandma comes in and, she wants to buy gold, or she wants to buy tech stocks, or she wants to buy real estate, or, she wants to buy oil, whatever that hot asset class is. And so, we're starting to see, gold flatten out a little bit. Obviously, Bitcoin is, way off of its highs. So I don't know if you had anything else that you wanted to add there.
Yeah, I mean, our phones were ringing off the hook at the end of last year with people calling in and asking about gold and what's the outlook? Why is it running up so much? It's a asset class that historically we don't see run up in such high amounts and high returns. So we were getting a lot of questions, and at this point we're kind of seeing the other side of that run up right now, right?
Exactly.
Yeah, we've seen a lot of the money managers, Nick, where we were seeing with models that we utilize for clients in-house. We saw the introduction of gold, whether it was BlackRock model, JP Morgan, Fidelity, LPL, whoever it was. Basically, across the board, money managers were bringing in some sort of gold percentage, whether even if it was nominal, maybe 2 or 3%. And now, as the models have shifted more toward, again, some of the emerging markets and small caps, we've seen money managers completely eliminate gold,
Right.
which I think is a good thing because they were intuitive enough to realize that, hey, gold has probably hit an all-time high relative over the last few years. So let's lock in those gains and now shift it into something that's going to be more fruitful. So I think when you said before, Paul, about just the benefits of tactical asset management, this is just another component to say, hey, tactical management can add a tremendous amount of value, even if it's in small quantities.
Right. And to your point, it's good. It gave us, as money managers, a good opportunity to take profits on certain alternatives like gold and kind of move those profits into other alternative strategies.
Yeah, absolutely.
And we're going to talk a little bit more about fixed income, but it's just important to know that we've as it relates to fixed income, we've been on a little bit of a roller coaster as it relates to where interest rates going. I know you're going to have some more stuff on that in a minute. So
so we just talked about where we've been over the course of this year, the first half of this year. Let's turn gears here a little bit to looking forward, some of the key takeaways from July and moving forward throughout the year. So in the next couple of slides here, we're going to talk about these three big components, right? We'll look at oil and how the price of oil has actually come down as of late. We'll look at the U.S. economy, how we kind of foresee the economy going over the next 6 months here, and how it's remained to this point resilient through high inflation and talks of interest rate changes. And finally, talk about the markets and the Fed path.
We have a new Fed chairman.
Kevin Warsh.
Mr. Warsh.
Mr. Warsh.
If I can pronounce that, Warsh.
Warsh.
That's like when they make fun of accents in New Jersey. That's what they say. We say when we say wash.
Yeah.
Right.
Yeah. Yeah. If you're from New Jersey, your host is going to say that name.
Thank you. Was a lot easier.
So one of the biggest geopolitical events we've seen in the past couple of years here is the conflict in Iran. And that really has led to a lot of changes in the price of oil and the energy sector in general. If we were to go back and look at some of the energy prices and energy sector as a performance metric through the first half of the year, it's performed very well because we've seen oil prices starkly increase due to this whole supply and demand effect. When we saw Iran kind of shut down the Strait of Hormuz, right, and disallow vessels to move through there with barrels of oil. So if you take a look here, and this is a chart on the left-hand side of oil moving through that strait, where they got close to 100 vessels on average in a normal kind of day of travel through that strait. And once that was shut down in late March, that number dropped to less than 10. So as this conflict's kind of evolved, we've started to see a bit of an uptick as of late. Now, this might be a dynamic situation as new headlines come out every day of what's happening.
Every hour.
Conflict every hour, right? We're seeing headlines. But as of late, it looks like we're trending back towards that normal. I mean, we're still only at a third of what the normal is, but we'll see where that goes going forward, right? We don't want a supply shock to oil, which will cause prices to fluctuate very rapidly, right? And the price of oil to therefore increase.
Right.
But we do see on this graph on the right-hand side, investor sentiment is getting towards, close to a high, right?
Mhm.
People and investors are expecting this conflict to come to a close, for prices to return to normal, and for the market to kind of steady out, right, and
Yeah.
continue on this bull run that it's been on.
Yeah, it's always the fear of the unknown, right? It's amazing because, I even look at the conflict with Ukraine and Russia. And when that first started and Russian troops, marched into Ukraine, that had a huge impact on the global markets. Because there was the uncertainty around what was going to happen, right? Was it going to be a world war? Was it going to be contained to, Crimea? Where was this all going? And it's amazing because that war's been going on for what, 3 years?
3 or 4.
3, 4
Yeah.
years.
Yeah.
I couldn't even tell you, like it doesn't even have an impact on what goes on with the markets. And when they were saying, Ukraine is the world's breadbasket, and the amount of crops that weren't going to hit the markets, and it's that uncertainty that really shocks the market. Not much different than what's happened in Iran. So I think as soon as that certainty comes back into the market with that consumer sentiment, it really paves the path forward, good, bad, or indifferent. But it takes away the uncertainty.
Right.
Yeah. And this is important as it relates to what we're going to talk about with interest rates, because we came into the year thinking that interest rates were going to continue to nosedive, and that's not necessarily the case, and this is part of that story.
So yeah, Paul, if you'd like to talk a little bit about the kind of outlook of the U.S. economy and how we expect it to perform.
Yeah. So, the economy has stayed resilient regardless of, what's happened, around the rest of the world. And, we look at, payrolls rebounded strongly since March. We did see a drop off, at the beginning of the year. But since then, payrolls have been very strong. And, Kevin, I know that you and I have been talking about, the economy, and you can't talk about the economy without talking about taxes, because they really go hand in hand when we look at economic growth and where we are as a country. One big beautiful bill, we're sort of seeing it in full effect here.
We're seeing the effects of it, and everybody thinks that especially in New Jersey, New York area, that the salt is the greatest thing that happened, and it certainly helps, and we'll talk about that. But we were surprised at the number of people that benefited from the overtime, the premium not being taxed. The big issue with that this year is the companies that issued the W-2s weren't required to show that for 25. So many of our clients spent several hours looking at all their pay stubs to come up with what the amount was, but it was worth it. And the other one was the one is tips. Okay, because now tips are not there. There's no tax on the tip, which prior to this was reported on the W-2s if you tipped using your credit card.
Yeah.
But the cash never showed up.
Yeah.
So indirectly, I think it's a way to make the cash show up as well as everything else. So these two things were a big help for a lot of blue collar, a lot of other individuals that are paid either with tips or with the other.
Yeah.
For this year, the tips, or both the tips and the overtime should be not an issue because the W-2s are required to have that information this year.
Thank goodness.
Yes.
Maybe we should get them to do the same thing with a QCD.
Yeah, that would be nice. Yes. So, but let's talk a minute about the SALT. A lot of people think it's real estate taxes, which it is, but it's also unemployment tax, New Jersey income tax, and all the rest of those ones that we wind up having to pay. So it's substantially more than just your real estate.
Yeah.
The other thing to think about is, as far as owning more than one house, you can take the interest on 2 houses, but you can take the real estate taxes on the plethora you may own. So you can boost up to that $40,000, which has been raised for next year for 26 to 40,400.
Oh, nice.
So that's another $400 worth
Yeah.
of real estate taxes. So those are the big things, and they affected people's returns and their refunds
Mhm.
more than we first thought they would.
Yep.
And I guess the other thing is for seniors is there's an extra 12,000 if they're moderately income earning, and
Yep.
and that certainly helps.
Yeah. And
So-
and all this goes back to fueling the economy, right? 'Cause,
Yes.
you know, money in the hands of you know, citizens is, you know, something that, you know, spurs economic growth. So, you know, having seen that firsthand, you know, is really
Right.
really kind of cool. You
It
know,
was.
you hear about it and you debate about it, and then, you know, you actually see it happen. It was funny because we're out at a restaurant, and I don't know if you tip in cash, but, you know, because of, you know, you knew that if they got the cash, then, you know, they weren't going to have to pay the taxes on it. And, you know, so that was something typically that I would try to do. Now I don't do it anymore. And thinking back about it, I'm like, wait a second, we own an accounting firm and I'm helping people with tax evasion. So, I'm going to continue to put my taxes on the tips on the credit card. So, you know, as far as GDP growth, you know, we are looking to see, you know, some positiveness there. So, you know, anytime we see positive economic growth, you know, indicates that we're not looking at a recession. So, you know, we're looking at you know, that through at least, you know, the second quarter of 2026. So
Yeah, definitely those the no overtime tax and the no tips tax, Kevin, it makes sense because you look at the fact down here, right? I mean, the biggest industries that hired payroll were, you know, health and education, right? So think all the hospital employees that work tons of overtime and leisure and hospitality, right? So like restaurants, you know, any sort of, like you said, blue collar type of employees. And that's really, I think, allowed these sectors to really percolate and flourish. So, and then with the additional taxes, right, it just kind of feeds the cycle back in, right? More people are going to use their discretionary income to go out and enjoy their lifestyle.
Well, especially this year because they weren't planning on that extra 2,000, whatever it might be, from these things because it was brand new. So
Yeah.
it was good.
Yeah. Yes.
makes it easier delivering a 1040 to a client.
Yes, as long as it's positive.
Yes. So, you know, when we look at everything that's sort of transpired, you know, with the geopolitical markets and, you know, the Fed having a 2% target on inflation, we have a new Chet Fairman, chair.
Fed chair.
Yeah, go ahead. You can take.
I can take this one.
It goes back to the wash.
Yeah.
Tongue
The
twister.
Wash, the midsummer blues, whatever you want to call it. The heat getting to you. So, you know, this chart is particularly interesting, right? So if you look on the left, this is how inflation has sat historically, right? Everyone knows that coming out of COVID or the height of COVID, you know, inflation spiked very, very quickly, right? I mean, we saw core inflation, you know, above 8%, approaching, you know, 9%, 10% in some sectors. And, you know, the Fed, well, you know, you can go back and forth and say they were a little slow to get on the ball there, but, you know, they have done their job slower than people hoped, but they have done their job to get inflation back down. And, you know, what's interesting now is that when you look at the chart on the right, you know, we see that, you know, we see inflation just on the left real quick. Inflation is starting to spike back a little bit, again, due from the Strait of Hormuz closure. And it's funny to see the chart on the right is, you know, where the rates have started to trickle down, and then the different dotted lines are where we saw the Fed changing rates moving forward. So, you know, back in February, before this Iran conflict took place, right, people were still forecasting that the Fed was going to continue to reduce rates, right, drop them down. We can see that yellow step down over time, getting closer to the 3% mark by the tail end of this year, and then hopefully continue into 2027. As the conflict arose, we saw a change in the Fed sentiment and how they're viewing rates. And now the market is actually starting to price in the fact that there actually might be a rate hike this year, which is something the Fed hasn't done and has not wanted to do since they started lowering rates. We've seen them push out rate cuts, not do them as frequently. We've seen them reduce how high or how low they're going to move the rate cuts, but we've never really priced in the implication of potential rate hike. And this is the first time we're seeing that now in the last 3 years. And people might say, well, it's only a quarter point that we're projecting out, not a big deal. And for the most part, investors are going to be correct in that regard. But the big impact is that how it's changing the fixed income markets, right? A lot of investors have introduced fixed income instruments into their portfolios over the last few years, whether it was a CD that you capture at 5.5%, a money market maybe at 4.5%, high yield bonds, muni bonds that you could capture at, sometimes 6, 7, maybe even 8% in some places. And of course, the inverse relationship between interest rate and bonds, right, is that if you lock in a high interest rate bond and then rates continue to go down, not only do you get to keep that high rate, but the value of your bond or your fixed income goes up. So it's a win-win on both sides for bond investors. And if rates start to go up, we're going to see that change, right? Where if rates go up, now that if you own a higher yielding bond, the value for the first time in a few years is going to start to fall, right? And this is a big deal for investors that have introduced fixed income into their portfolios over the last year, right? And if you're owning more longer term duration fixed income, something with maybe a 10, 15, 20-year maturity, that's going to be more painful if rates do end up going up. So I think we're going to see a shift, not really out of fixed income per se, but we're going to start to see a shift of how fixed income is owned, right? We're going to see shorter term duration bonds, durations with 1, 2, 5 years at the most. And investors that continue to hold those longer term durations have a higher risk of getting burned or losing value on those bonds. So I think that's the biggest impact that, again, the Fed's going to continue to change rates, right? That's going to be an important factor. But how it relates to you as an investor in your own individual portfolio, I think this is where, people need to follow this very, very closely.
Yeah, I mean, and even, within our own clients, we were positioning clients to be longer on the spectrum of fixed income, thinking that rates were going to continue to go down and, that we were going to be able to benefit from that. And we've had to pivot, to make sure that we're not stuck too far out, on the yield curve here. So, something very, very important to keep in mind as, the days and the months continue here through 2026.
Yeah, absolutely.
AI.
Yeah, those two
AI.
letters. We've heard a lot about them over the past couple of years, and we'll keep hearing about them.
Holy cow.
Yeah, it's these charts really go to show how impressive the AI trade has been, and where we expect to see it going forward. Right, it's become such a large part of the S&P 500, as we talked about at length. Right, with a lot of the AI companies, moving to the top and just becoming a large part of the S&P, but rightfully so. Right, they're driving the earnings, they're driving the returns. And we're still expecting the AI companies to increase their earnings going forward, right? And if we look at how it compares to the non-AI stocks and our outlook on non-AI stocks, it's an incredible difference between
5 times
AI
and
the non-AI. Right. So we don't want to shy away from these companies. We don't want to shy away from this transformative technology when we talk about our equity portfolio. And we still see a lot of room for expansion in other companies to go ahead and integrate AI into their processes. Right. This chart on the right kind of gives that visual there, where the top 1% of companies are spending a lot of money on AI and they're implementing them, but the 99% of the rest of the companies, they're down $611 per employee or $11 per employee on AI spend. So it can be integrated more into different parts of the economy and start growing other sectors of the economy as well.
Yeah. One of the things that I don't know, and I even struggle with this myself as it relates to AI, and just a funny side note here is that I started watching Little House on the Prairie on Netflix. They put out the series from the book. So it's different than the show, if anybody has seen the show. But it's so relative to what's happening with the AI in the economy as, what happened when we were an agricultural economy moving over to an industrial economy, right? And they went out and they settled the plains, and the next thing you know, the railroad's there. And you look at all these jobs that these people are doing that are like gone, right? I mean,
Yeah.
they're just gone, and it's like, holy cow, like same thing's happening within AI, like, all these jobs that AI is going to be eliminating is not different than having an ice house on a lake, giving ice for somebody to be able to have an ice box. So it's going to be really interesting because I think, when people are thinking of AI today, they're really looking at it as, how is it improving or adding, time back to my day from implementing an AI technology. But it's so much more than that because we're moving from, what I always referred to as the internet number one to the internet number two. And you even look at Google searches and what's happening with Google searches as it relates to AI, right? Because people are not using Google the same way that they were using Google. They're using, one of their, favorite AI tools. So, that's what's important to sort of think about when you think about AI, because people think that it's overdone and it's, all the, it's already been done and, the values are there. But I don't even think we've seen 10% of it.
Yeah.
I think the economy is going to completely be different, 20 years from now as it relates to AI. So I know we're getting tired of hearing about it, and we're tired of hearing about NVIDIA. And, I mean, NVIDIA was a game chip company.
Yeah.
Think about that. I mean, they were, if you had the NVIDIA chip back in the day, right, when you were gaming, you were like top dog.
Yeah. Everyone wanted to come over to your house.
Yeah.
Yeah.
So just keep that in mind, that when you are thinking about AI, that, there's so much more to come that, I don't even know if we have the imagination to think about sometimes.
Yeah, and as it relates to the stock prices of these AI companies, a lot of people are getting concerned that it's overblown to a point where these AI companies are getting too expensive. But with this increase in the earnings, it's kind of keeping the price to earnings ratio low enough to where it's not at a point to where it's super expensive or super overblown, right?
Yeah.
Because earnings are expected to perform
Yeah.
so well that it's keeping the stock a relatively good investment.
Yeah. And the other thing to keep in mind there is that, companies aren't spending millions on this. They're spending hundreds of billions.
Yeah.
And I mean, the spend is astronomical. I mean, it's just off the charts in terms of, what the investment is here. So enough of AI. I'm over it.
Well, enough of AI, but we'll talk about it just a little bit more because we're going to talk about how emerging markets has really, again, taken a front seat as, one of the leading sectors over the last 12 months. And AI did definitely have a portion to do with that, right? So, again, we know that emerging markets tend to bounce back when geopolitical risks ease. So, of course, we saw the easing of we're continuing to see the easing. As it stands today, that could always change tomorrow, right? But we're seeing the easing of the Iran conflict and the Strait of Hormuz being reopened, right? So we know that the emerging markets, which is the orange bars there, and the Europe, Asia, and Far East Index, which is the yellow line, really looking forward as it's doing quite well. It has done over the last 12 months or so, and also looking at where if we're looking at it a little bit in more detail, where investors and money managers are looking to position that emerging markets. It's because you could say I want to buy emerging markets, but it's like, well, what emerging market do you buy, right? And we can see that the countries like Taiwan and Korea especially are really taking the hot seat of where that money is being positioned. And a lot of this is due to AI, right? We're seeing huge infrastructure being built in countries like Taiwan and Korea because that's where the investments are being made to develop a lot of the chips, a lot of the technology, which is all fueling the boost of AI. So it's almost creating that full circle of, we're seeing AI stocks do really well. The money is continuing to being poured in. It's being poured in through investments in countries such as Taiwan, Korea, which is why when people say, oh, we're in an AI bubble, I mean, sure, AI has done tremendously well, but we're not seeing it as a bubble, right? We're not seeing it like the dot-com bubble where, companies threw billions of dollars at a technology and then nobody bought into it, right? This is a totally different scenario where like you said, Paul, those hundreds of billions of dollars are being bought in, and the supply can't even keep up with demand.
Mhm.
Right? I mean, the demand for AI is through the nose right now, and it's going to take a while for companies to be able to provide that supply, and that's why we're seeing again such a big boost of where emerging markets are doing so well.
Yeah. And then there's going to be the unintended consequences, right? I mean, we're already hearing the political fights of power plants and energy prices, and so that's going to be the big thing as we continue to look at this. Is what country is really going to come out dominant, as it relates to energy policies to figure out this
Mhm.
this demand. I think back, and this is where I really think it's cool. Kevin, I'm sure you have the same feeling. You think back, to different parts of our career where different cycles have happened. And back in the late 90s, there was uh, a big push in emerging markets, the BRACs and the BRIC funds and all this other things. And there are countries out there that never had copper phone lines, and they went right to cell phones. Right. And that was the big thing. It was like, these people in these countries were getting cell phones because it was cheaper for them to put in the cell technology than to lay copper, for
Yeah.
the phone lines. And we're starting to see stuff like that happen again as it relates to emerging economies. And the technology. I mean, if you have a cell phone in your smartphone in your hand, with all the same information, and it doesn't matter where you are in the world. So, that's going to be, another game changer as we're talking about emerging markets and, how those different economies are going to be able to grow because the infrastructure doesn't have to be the same as it would have been 30 years ago. So very, 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 very cool.
Yeah.
Some of the AT&Ts and Verizon are now requesting states to not have to put in copper wires at all.
Mm-hmm.
Yeah.
So we see that whole switch even here.
Yeah. Yeah. Take the copper and sell it.
Yes, right.
Yeah. Scrap it.
All right.
So, as we're starting to get towards the end here, obviously the big question to a lot of us is, okay, we've talked about where opportunities are with our investments, but how do we go about actually implementing it, right? That's always the biggest challenge is how do I, get rid of maybe some of my asset classes that may not have as much potential for other asset classes that have more potential. So Paul, being our lead trader here in the office or our sole trader, you want to go through some of this stuff and sort of explain where investors can find some opportunities?
Yeah. And this is, again, we believe in tactical asset allocation. So, if you're going to go into something, it doesn't mean that we don't like something, but something's got to get trimmed, in order to make the space for, other opportunities. So, we put this together, obviously stay invested in equities. We're not, trying to have people reallocate, out of equities, but, definitely consider, large cap core, look at small caps to maybe, just fund some of that core. Follow the earnings. I mean, Warren Buffett always says, find a trend and throw yourself in front of it. And that's really what this is about. Follow the earnings. Where are companies making money? Nick, you talked about, how much revenue is coming from AI versus, the rest of the world. And, we've talked about it, and, it still continues to be a concern for me as it relates to equities, is that the S&P 500 is becoming so overweighted in so few companies, and that's why we're sort of stressing core and build around it. But global AI, I mean, look, if we're not looking, 3 years ago, we weren't talking about international because it didn't make sense, right? There was just not a lot of, conversations had outside the United States as it related to investing. And, we've shifted that complete thought, where, a lot of portfolios now we're 20% international, 20% or more. So, look at these things, global AI, emerging markets, still, can be a trend for, some time. And then, one of the things that, has sort of ebbed and flowed over the years is, alternative strategies, things other than stocks and bonds. And the reason why they sort of ebbed and flowed, at least from what I've seen in my career, is that to get into some of these was so difficult. You had to be, an accredited investor, or, the mechanics wasn't there. You had to get into a limited partnership. Then Kevin will yell at you for all the K1s that came after, filing a tax return. So, there was, from a tax standpoint, from a vehicle standpoint, it was sometimes harder to get into these alternative strategies. Now with the, advent of technology and how things are shifting within investment vehicles, alternative strategies are a lot easier to own than they used to be. So it's a reason to continue to look at them. And then, Ben, you talked about this as it relates to interest rates, but, look at the front end of the curve. We were starting to go out, a little bit past the middle of the curve, but we're so uncertain, that interest rates are going to continue to fall. Maybe they stay flat at best. But to think about, 3 or 4 rate cuts like we had talked about at the end of the year, I think that conversation is sort of off the table.
Yeah.
Yeah.
Yeah, definitely.
Yep. Not sure if we have any questions, but feel free to.
Looks like we have one. Text is a little small.
Yeah. There is one question. We'll get it off on the side a little bit more than this conversation. So we will answer that privately. But if there aren't any other questions coming in, maybe we'll just go around the table for final thoughts, and we'll start with our guest.
I think it's the change, the Trump changes, I think will continue to spike the economy.
Mhm.
And I'm not sure that's what it was intended for to begin with, but I
Mhm.
think that's what's happening.
Yeah. And it'll be interesting because, we have a joke when we meet with clients, that they made the tax codes permanent. And then the next words out of our mouth are until they're not.
Right.
So, I think for me, as it relates to tax planning, super important not to lose and put blinders on and think that, we're going to be at these tax rates forever, because we have midterms elections, which I purposely left out, just because I don't like to cloud, politics are too far out when we don't know what they're doing. But anything can happen, and so, it's really important not to lose sight that, taxes are permanent until they're not.
And most of these changes are only in effect till 28 or 29.
Exactly. Take advantage of them.
Yeah.
Final thoughts, Nick?
Yeah, I think halfway through the year, we've seen a lot of great returns. We've seen kind of the momentum of the past couple of years continue going with the bull market and the AI trends. There will be some big events coming forward, with a lot of changes in midterm elections, like you alluded to. Kevin Warsh as a new Fed chair, right? So just be aware that markets are continually changing. Sectors are continually changing. There's opportunities that will exist. There's opportunities that will disappear.
Mhm.
And it's a good reminder to just be tactically invested, right? And remain invested and not super concerned with your portfolio allocation. And if you are, just give us a call and we'll talk over allocations with you.
Yeah, just echoing what you said, Nick. I think the change in the Fed chair, Mr. Warsh, right? I'm saying that right? Mr. Warsh is definitely indicative of what's going to happen. I mean, the talk of a rate hike is something that I think a lot of people weren't expecting, and that will have implications of the markets and especially fixed income. And I think just important to keep in mind that buying and selling is certainly a fine strategy for some folks, but there are definitely ways to take advantage of, again, as Paul mentioned before, there's ways to keep the same risk that you have, but still take advantage of different opportunities without, adding additional downside risk or limiting your upside return, right? So by being mindful of what's going on in the markets, and that's why we love to do these, quarterly updates, just to give more information and resources to everyone attending today. So you can go back to your accounts and portfolios and make informed decisions, or enlist the help of a professional and try to just make sure that your portfolio is aligned with your overall objectives.
Thank you, sir. And I'll take the last word here. First, I just want to thank everybody for taking the time to be with us today. Thank you for your business. Thank you for your trust. It means a lot to us to be a part of your lives, whether it's a webinar or a one-on-one conversation. We all, love what we do, and it's great to see the impact, that we have in such a positive light with those we serve. So, just thank you everybody for being here on the call. And I think, as I think about AI, and again, I mean, that's all we hear. And I get home at night and I'm just like, I don't want to hear about AI. Like, I fought with it today. I couldn't get it to do what I wanted it to do. It's here to stay. I mean, it is, it's out of the bag. And, you think about it, I was reading something as it related to Tesla, and, Elon Musk's pay has to do with putting people on Mars, but it doesn't say they have to be human. I just want you to think about that.
Yeah, that's
Right?
crazy.
Nobody said that they have to be human. So, I look at this colonization of Mars, something that I never thought would be a conversation at work. And I read his pay package and I said the word human is missing out of it. Yeah. So with that, I'll leave that as a thought for next time. Again, thank you everybody for joining us, and we'll look forward to seeing everybody again in 3 months. Take care.
Have a great summer.
Bye.